So passive investors think active investing is just like a probability game, like a coin flip. In theory, when you have a large enough of a sample size of investors, this actually might sound pretty logical. Imagine if every year you only keep half of the funds that outperform the market, and if you keep dividing the pool for the next 10 years, you're bound to have a handful of fund managers who consistently beats the market. The point is that really skills, or is that just pure probability? And this is where the great debate is. Passive investor complains about active investing on their high fees, especially with long period of underperformance, while active investor complains about passive investing with their laziness and mindlessness of the strategy. While both sides of the argument has their merit, it is important to understand both sides of the ideas in order to help us to become a better investor, which is ultimately what this channel is about. And hopefully by the end of the video, we could clear out some of the more common misconceptions that most beginners might have on both strategy. And now with that out of the way, let's begin. Okay, let's start with defining what active investing is. Active investing is essentially a type of portfolio that is managed by a professional portfolio manager who tries to beat a specific benchmark by picking different stock positions. So these portfolio managers will conduct a lot of research on the stocks that they are planning to purchase by speaking to management, building financial models from scratch, and kind of look at the financial profile and also project it out in order to see whether or not is a worthy of an investment. And a lot of times they also leverage a lot of alternative data in order to have an edge over other investors who is also looking at the same thing. And hopefully by the end of the research process, they could generate an alpha, which is the idea of an extra return over a specific benchmark so that they could satisfy their shareholders. And this is really time consuming. So usually you have a big portfolio manager who usually manage the overall portfolio, but then you also have individual research analysts who cover a specific industry vertical and tries to make investment recommendation to the portfolio manager. So internally, there's actually a whole process that every sort of research analyst undergone in order to get their recommendation and convince the portfolio manager to make a position. Funds like the hedge fund could be a little bit more creative in terms of mixing and matching long-short position, as well as utilizing different option strategies in order to beat their specific index. And as for fees, active funds are generally much higher than a passive fund because of the additional administrative and operational costs associated with running the investment team. For example, so the average expense ratio for actively managed mutual fund is usually between 0.5% to 1%, and they rarely go above 2.5 percentage point. But a hedge fund can charge something called the 2 and 20, which is a 2% flat management fee no matter the market condition. But at the same time, they can also take 20% of the additional gains that you might have because they are able to beat the index for a specific year. What that means is that as an investor in an actively managed fund, the portfolio manager for that specific fund needs to be able to consistently beat the market on top of whatever expense ratio that they charge. And that is extremely difficult over a long period of time. Well, unless you're Papadalio, Warren Buffett, or Jim Simon, then that is a completely different story. Now that we went over what active investing is, let's turn over to passive investing. So passive investor believes the idea that the market is logical and efficient, and all the information is available for all investors in the market. And also the fact that the stock price also reflects the true value of the company. So instead of trying to beat the market, you should just be happy with the market return because nothing you can do could allow you to get alpha over the market. And this is why a low-cost index fund like a SPY is usually synonymous with passive investing. Because when you compare the expense ratio for these type of passive fund, which is usually around 0.02 to 0.03%, this suddenly looks a lot more attractive relative to the high expense ratio of actively managed fund. You might think a few percentage point differences in terms of fees wouldn't really make the buck, but the cost that you pay for having an actively managed fund could actually cost you tens and thousands of dollars later on. Because of the cost saving that you're able to have by using a passively managed fund, that additional cost saving will also get compounded at a market rate. And let me show you what I mean. Assuming a market return of 15% at an expense ratio of 0.2%, and you invest roughly around 100K at day one passively for the next 10 years, by year 10, you end up with around $397,000. But if you invest in an actively managed fund with the same return, but at an expense ratio of 2%, then you're only going to end up with around $339,000 at year 10, or a whopping $58,000 less than what you would have gotten if you were to use a passively managed fund. And if we look at history, this doesn't look too hot either. According to data compiled by NYU Stern as well as the Barclays Hedge Fund Index, the historical hedge fund return has also consistently underperformed the market. And feel free to pause the video and look at here. But does that mean that passive investing is an end-all be-all investing method that you should just throw all your money into a passively managed fund and worry about it 10 years later? Is that really a better strategy overall? And like we said before, the argument from the passive investing community is the idea that the market is logical and efficient, and that the stock price reflects the true value of the company. So there's not much you could do to outperform the market. And since all the investors collectively forms the market, so using a low-cost index fund to match the market return seems like a pretty logical idea. The problem I have with the passive investing strategy is that the method becomes self-defeating when more and more investors decide to become passive investors. Because that means that the market no longer becomes efficient when fewer and fewer investors actively try to compete with each other by using business analysis and fundamental research. And at the extreme, if everyone practiced passively investing in index, then the stock price would never change relative to each other because there will be no one else left to actually move the stock price. And another issues I have with index funds is that the selection criteria is non-discriminatory, which is the idea that it would not consider whether or not the company has specific investment merit. As long as it fulfills a certain criteria, it will continue to buy them. And let's look at the State Street Spider, for example. It will update monthly according to the market or whenever there's a change to the S&P 500. So at its core, it will never consider whether or not a company or a stock has any investment merit, as long as it fulfills their specific criteria. And at the extreme, if the entire market could stay irrational enough and allow shitty companies to be part of the S&P 500 index, then these index funds will continue to buy these companies in their stocks as long as it can continue to fulfill their criteria. And remember the chart I showed you before, like right here? The data in this chart only captures the funds that publicly release their results. So that means that there's a good amount of privately held hedge funds that do not publish the result publicly are not captured in this table. So do take everything with a grain of salt. So in summary, what is the pro and con for each of the respective strategy? As for passive fund, the pros are ease of access, low fees, your process could be automatic, and most likely you will outperform the majority of actively managers over the long term. As for con, in the short term, you're most likely to have a lot of market volatilities, limited returns, and a focus on large cap if you do focus on index fund, and also stock concentration if you do decide to invest a specific industry ETF like the QQQ. As for active fund, the pros are usually a lot of flexibilities, alpha, as well as a tax loss harvesting strategy if you're an ultra rich person. As for con, the performance is mixed. You also have a lot of high fees, and you also have a difficulty of choosing the right portfolio manager. Because how do you really evaluate a PM? Yes, looking at the history might help a little bit, but picking stock is already hard enough. How can you actually evaluate the person or whether or not they're really a good portfolio manager, that they're able to take care of your money and create a good return? Obviously, for top portfolio manager or top funds, you also have a lot of limited access as well. And obviously, not all funds are created equal. Let's take the Renaissance Medallion fund created by Jim Simon, for example, which charges 4 and 50, which is the idea of 4% management fee and 50% of the return that you're able to get. But from 1988 to 2018, they were able to generate an annualized return of 39% year over year after fees. So $1 invested in the fund in 1988 would have turned into $200K by the end of 2018, and that's fucking insane, my friend. At the end of the day, this channel is about creating a balanced view on things. There's not a specific strategy that will obviously be better one over another. At the end of the day, you just gotta figure out one strategy that works for you. And I like to measure things from a stress to return perspective. If investing in a specific strategy are always keeping you up at night and is making you stress, then what's the point of having 1 or 2 extra return? And look, don't get me wrong, some people enjoy the excitement, so it's really up to the individuals, right? And if you're indecisive like me, why don't you just start with a 50-50% allocation on both of the strategy? And as you grow more comfortable on one strategy over another, then just allocate more of your future dollars into one or the other. But whatever method you choose, there's a few things that you should be mindful of. Number one is the fees, because that actually eats into your return. So do look at the prospectus really carefully in terms of any sort of hidden fees that they might have. And number two, have a long-term mindset and budget accordingly. Don't throw all your entire life savings into either of the strategy. Have some cushions, plan for the future, and market could stay irrational longer than you could stay solvent. So do budget accordingly. And three, just diversify. I know this is kind of like a really old advice, but you don't want to put all your eggs into one basket. And sometimes diversifying your asset allocation could also be beneficial if the market do run into a really big downturn. And look, none of this is meant to be investment advice. So do take everything with a grain of salt. And this is all for educational purposes. And if you want to learn more, do consult with a professional investment advisor for more information. And this is about it. I give you some pros and I give you some cons about both sides, and you kind of make the decision from here. And if you enjoyed this type of video or you have some other ideas in mind, feel free to drop comments below and let me know. And thanks for watching, and I will see you next time.